going on, everybody? 360 Digital Closing Bell. I am your humble correspondent, Michael Tanner, joined live from an undisclosed location here in Denver, Colorado. As always, we're not really live. We're recording this Sunday at about 10 o'clock Mountain Time. It's a great day. We have a wild show lined up. As always, I am joined by the purveyor of the show, our humble producer, Stuart Turley, who's the director and publisher of Oil and Gas 360. Stu, how you doing today?
I'm doing fantastic, Michael. It is great to spend time with you. We got a packed show.
We have a wild show, and before we really get into what the show is going to be about, this show is brought to you by our fabulous sponsor, Adamantine Energy. We are so excited to have them on board as a sponsor of the show. Adamantine Energy advises energy companies on future-proofing against social risk. Their principal, Tisha Schuler, is one of the best industry thought leaders when it comes to navigating everything from social risk, but also to board strategy. How do you navigate as a board of directors around all of this ESG? She's also an expert at de-escalating conflict. She's very tapped in terms of how to access energy of all different types to help grow your operations. And obviously, she's big on the technology side of things. They are an excellent sponsor. We did an interview with her about a week ago that has done. I mean, the numbers have been incredible on that.
They have, Michael. Absolutely wonderful. We are so thrilled to have them on board.
So it'll be nice. And so please check them out at www.energythinks.com. She's also launching a podcast called the Energy Thinks Podcast, which will launch sometime in the next 2 weeks. Full disclosure, I'm putting that together and I haven't really gotten around to doing it. So I'm waiting on a graphic from her, but it's going to be awesome. I'm so excited to get all of this stuff going for it, and it's great to have them on board as a sponsor. We have a great show lined up. We're going to chat and really get into the earnings season from an exploration and a service side and talk about what we think this means going forward. About a quarter of companies have come out and released earnings, and I think this kind of sheds some light on what it is moving forward. We're going to go to the week of oil. Stu's got some great stuff from the international Newsdesk. We're going to dive into a little proration stuff. As always, we'll check the levels, check in with the commitment of traders, and then we will get to our official, non-official fund. We don't have a name for it yet, so we're still taking suggestions for names. TomCat's got some great picks. I'm sort of standing still, and Stu's going to add a little bit to his position. Before we dive into that, please, if you are not subscribed to the 360 Digital Closing Bell on iTunes, Spotify, Entercom at YouTube, please pause this show, finish. Well, download the show first. Don't just listen. Download, subscribe to the show. We really appreciate it. Whatever makes the algorithms go nuts, that's what helped us get more. We actually had a great first month. The numbers that we saw were far exceeded what I thought we were going to see. So I really appreciate everybody who has listened. You can follow us at Oil and Gas 360 on Twitter and LinkedIn. Those are about to get revamped, people. So hang in there. You're about to go for a wild ride in the month. We're going to be doing some revamping. I'm excited for that. You can connect with me and Stuart on LinkedIn. Michael Tanner, Stuart Turley. We have some great interviews dropping on the Energy 360 network. On Tuesday, we're dropping Premier Oilfield Group, and on Wednesday, CAC, which I'm honestly really interested. I haven't cut this video up yet, but I'm interested to do because this is all about DOO insurance, which is something I was very unfamiliar with. I'm excited to just kind of learn about a new part of the industry. I think that's why the Energy 360 network is excellent. Is there any other things that we're dropping here soon that we need to make people aware of?
Yeah, we have a couple, but we also have some great interviews lining up. Fantastic.
Oh, we do. We don't know when to announce them yet, but yeah, we've got some really good stuff. We got some really good stuff lining up. What's the update on our Chinese media appearance? Do we have that? I downloaded Rosetta Stone over the weekend, and I've been speaking. Yeah, I've been starting to speak Mandarin. We're doing. I think by next Friday we'll be good to do the show in both Mandarin and English. So we'll kind of have two different versions.
Yes, I don't think they liked my charge. I was charging an international fee for them.
Well, yeah, I mean they're just gonna undersell. All they're gonna do is price gouge us anyway. They're just floating.
Michael, they got to pay for your talent. They really have to have your insights, and it's worth a lot of money to have that. So they got to pay tariff.
No kidding. So. Really what I want to do before we kind of dive into the week at oil is, I was looking at, over the past, let's say 15 days is when we've seen about 25% of companies, especially in the E&P publicly traded space, not really E&P, excuse me. I should say oil and gas because we're going to break it down. But they've about 25% of the oil and gas related companies, they've dropped earnings. And I know that was kind of a big thing that we were that has been on my mind. And I think there's just enough data from the companies that have dropped specifically on a couple different levels that I think it's worthwhile to sort of dive into and say, okay, what's happened and what do we think that means going forward for the companies that will drop? And how I want to really do this is break this down from two high levels. First, I think I want to look at the difference between what a service company looks like and an E&P company's earnings look like, because I think they tell two different stories. And when you look at the service side, honestly, most of them have already dropped. So the data that we see from these earnings are, it's real, it's up to date. So there's not as much projection as I think when we get into the oil and gas side, the E&P side specifically, there's going to be a little more projections. But from a service side, Halliburton, Schlumberger, and Baker Hughes have all reported earnings, and they're in with days with each other. And if you think it's a coincidence, it's not. That's just how things happen. And I think there's some interesting tidbits. First, Halliburton, I thought the big number was quarter one revenue only dropped 12% to $5 billion. That's year to year. So 12% drop year to year, which was really, really good. And that, that's interesting. Schlumberger down 5% year to year to $7.4 billion, which was very interesting. But this is the interesting part. Their U.S. revenue down 17% year to year, while their international revenue up 2%. I found that very, very interesting. And I think there's two stories that get told right there. One, only a 12 and 17% drop for Halliburton and Schlumberger's America Wings. I think that's a little light, considering the fact that, if you're on Twitter today, you probably saw the photos of the boxes being stacked up in the Halliburton Houston offices. It's going to get a lot worse for these guys. And, really what I think quarter one isn't factoring in as much of the layoffs and some of this downturn as much as I think you're going to see in quarter two. Only to see 12% drop in revenue from quarter one of this year to quarter one last year for Halliburton, that seems too light for me. That and that basically means they're, and I just think that means that the cuts that are happening in quarter two that are coming from the E&P side. When you talk about capital expenditures that are being taken off the market, I think you're seeing that roll out quarter two, quarter three. So that's what I'm looking for. I think these numbers are a little better than what people quote unquote expected, but when you actually just look at it, it makes sense. Quarter two and quarter three, I think, are going to be a little worse. The interesting part is international being up 2%. That is something that we heard on an interview with Miguel Pena and 10X Technologies. Remember this? He mentioned that their international sales were actually doing very well, correct?
Yes.
And so I thought that was very interesting to see that, not only hearing that, a couple of weeks ago, which is, that was interesting. Then to hear it confirmed when Schlumberger comes out and drops their earnings that their international is up 2%. So, that's to give you kind of the power of how international companies can operate at low oil prices. Schlumberger's biggest probably, most likely it's, Schlumberger's doing a lot of work in Saudi Arabia, which is very low oil prices they can break even at. So even at low oil prices, you can see a slight increase in investment just to keep up with the inflation that's going on, which is good to see.
You bet. Even South America is really a big opportunity for service providers, oil field service.
Yeah, you've been big on the South America in oil field, so we're going to have to do a segment on that at some point because you're really into that. So from a service side, I think the worst is yet to come, just because I think you're going to see quarter two, quarter three is really when the capital expenditures cuts come in from the exploration side, which always affects the service companies. I think you're going to fully be seeing the layoffs. It's going to be bad from their side. But from a quarter one perspective, it was actually not terrible. But that's really my key takeaway. International presence. If you're international, it's going to help you, but quarter two is going to be worse. And then there's the E&P side. And this is where we've only seen a couple of companies drop, but I think it tells a very interesting story. And this is where we can look into, okay, well, what do we think the next 3 to 4 weeks of earnings look like? You got to break E&P companies down even to another subcategory. You have to look at primary oil producers and primary gas producers. And I want to start with oil, and specifically I want to start with Exxon and Chevron because they give a tale for how the majors are playing this. And I'm going to let Stu give an overview. But what these do is, I think, give a great overview of how your mass majors, the ones that haven't dropped yet, how they're seeing this. We're going to be seeing some of the majors continue to drop over the next couple of weeks, how they're sort of seeing this outcome.
Hey, thanks, Michael. On Chevron and Exxon, I think it's kind of interesting that came out. Got a news article on Oil and Gas 360 on this with a summary, and Chevron had first quarter earnings of 3.6 billion, cash flow from operations at 4.7 billion. I think it's kind of interesting that Chevron is looking to decrease again their
Mhm.
capex spending. Okay, so good information and interesting information from Chevron. Exxon delivered the first decrease in a dividend since World War II. We had that story go on earlier.
Really?
Big difference on Exxon. They're reducing their payout on their dividends, which is a huge investment, Michael. I think you said it's on every retirement uh, fund out there, right?
Oh, dividends. Everybody loves them dividends because that's how you get paid quarterly on stocks. I mean, if you want, there's the idea. Investing in equities isn't mailbox money like investing, say, real estate. You don't get a check every month. But if you have a high dividend stock and you can check out using they're called yield rates, like a high yield dividend stock, oh, that pays you quarterly. So no, it's not to dive in, but yes, love me a good long-term dividend stock. If you're, yeah, that's all I'll say
Just
about
real quick, and I'll turn it back over to you on this.
it. Oh, no worries.
Cash flow from operating was $6.3 billion
Ooh.
on Exxon. Their capital exploration expenses was 7.1 billion. Now,
Ooh.
why aren't they putting out there instead of reducing capex, they're taking a hit on their dividends? Not sure how I like that messaging from the management. So that's all my opinion on those two.
No, and I think you bring up a good, you bring up a good point with the mixed messaging. I mean, they're still investing, and I think what you're seeing is companies like Exxon and Chevron. I think they're using this time to shore up their balance sheet because I think they see quarter three, quarter four as a huge M&A time. I think what you're going to be seeing is, all right, let's use this period of low oil price to go after the financing that we have access to because Exxon and Chevron are Standard Oil. When you think about it, I mean, they've been around since 1900, so they have a pretty good credit history. The banks are pretty, even in this time, are very willing to loan Exxon and Chevron money. They do because they actually make money. So I think they're using it as a time to resense their balance sheets a little bit and look to the M&A season, which I think is going to be this summer and then moving forward when you see a lot of this stuff. Among, I think, and so they shed a light into how the large IOCs look, and we'll see some, and we'll see a couple of them drop as we continue. But in terms of hardcore large shale operators, I think the one that screams warning to me, or I think what sheds some light into what's going to happen is Concho. Concho is a Midland-based and Midland-headquartered oil and gas operator. They produce out of two regions, the Midland and the Delaware Basin, and really they have great acreage. When you look at they do have a large, a decent majority of their stuff is what we would call tier one acreage. And if you want to know more about what tier one acreage is, I encourage you to go back and listen. I think it's episode 8, 9, yeah, with Nick Berry, we talked at length about, from a reservoir perspective, what is considered tier one acreage versus tier two. What's the actual difference? Because we hear those terms a lot. Oh, this is tier one acreage. This is tier two. What does that actually mean? And to someone as me, like an analyst, well, what does that mean? I'm looking because I'm interested in investing in companies that are probably tier one acreage. I mean, that doesn't take a genius. There's some genius statement there. But Concho, they have good acreage, but they write down 10 billion in assets, and that's a lot of because they're using this to redo their balance sheet. And a couple things here. One thing I was first, a little tidbit: they only hire Texas Tech engineers, so I mean, take that for what you want. I know that on good authority that they only go to Texas Tech career fairs.
Michael, what's wrong with Texas? I'm a
There's
little
nothing wrong
biased.
with Texas. I just thought it was an interesting fact to put out there that they do only they only hire Texas Tech petroleum engineers.
Colorado School of Mines, one of the best schools in the country, but don't mess with Texas.
No, I agree. I'm just I thought it was just full disclosure. And another thing, and this is partly what I think. Concho they're writing down 10 billion in assets while they're delivering maximum production. And I know they said they've now announced they're going to cut even more. They came out and said they were going to cut 20%. Now they're up to almost 50%. Well, you want to know why they've increased their production cuts? Two reasons. First sentence on their Q1 guidance. I'm not joking with you, Stu. I'm not joking with anybody. This is first statement on their Q1 guidance. You can view this on their website. Quote, delivered oil production volumes of 209 million barrels per day, exceeding the high end of the company's guidance range. I'm not kidding you. That's the first statement. Great job, guys. Great job. Exactly what needs to be happening right now in Q1. It's just so, and then the rest of the statement I'm hearing about non-GAAP free cash flow. And for everybody who's not an accounting person out there, GAAP stands for generally accepted accounting principles. So when you hear like GAAP accounting, it's just basically the general practice of accounting. So whenever you see non-GAAP accounting, you know what that means? Non-generally generally practiced accounting practices. So anything that says non-GAAP, you just don't look at. There's no need to, because it doesn't really mean anything, because it's not the generally accounted practice, and it's just a way to make them look good. And the problem is non-GAAP free cash flow has become the greatest term for shale oil companies in the past 5 years. It's been unbelievable. I mean, it's a great sleight of hand they did. Non-generally generally accepted accounting principles free cash flow. We're going to start turning in non-generally accepted podcasts and see what happens. So are we going to get, we'll see what the boss thinks about that.
I don't think that would be very good.
No.
Hey,
so
Michael, you talked about non-GAAP a little while ago. You have EBITDA, EBITDAX, and then EBITC, which was earnings before taxes and after Corona. You came up with that one, right?
I did not come up with that. I saw that on I think that was on a Haynes and Boone weekly track. But I'm talking, we're going to start putting out non-generally accepted podcasting principles. And we're going to start saying, we're doing well, but it's not by anyone's standard. It's just by the own standard we made up. So it's just
Michael Tanner standard.
Yeah. And it's the notch. So we'll see how the boss likes that, large oil cuts are, and so I joke around. All it is to say, these large majors who are primarily shale operators, the proof is just in the pudding. When they talk about cuts, they talk about we need to pull back, and on their Q1 guidance, they talk about delivering oil production volumes at the high end of the company's guidance range. Now, the other side of the coin is, well, they haven't had time to turn that off. This cuts off February. This doesn't take into account the majority of Corona. Well, yeah, I get that, but there was a problem before Corona, and the fact that nobody saw that even before this coronavirus and so what I think this means going forward is that's what you're going to see with a lot of these shale operators. I think you're going to see they were producing high production volumes into late Q1, and they might even say their entire Q1 they were producing at the highest oil volumes they ever have, because it's just no one was expecting A, Corona, or B, this demand stuff. And whether or not you think that's real, that's what I think you're going to be expecting. And that's why I think you're going to see a lot of these non-GAAP free cash flows and a lot of these oil companies. I mean, it makes my head spin sometimes when I read this stuff, because I'm having to be like, this doesn't make sense. It's just a lot of words strung together, and it has a number that's like 800 million. And you're like, well, what's that mean? I don't know what that means. And then you actually go look at their revenues, and it was like, well, we lost 300 million that quarter. Well, where was that on the first 3 pages? So, and I'm just using those as examples. It's just that stuff makes my head spin. And if you follow this stuff, if you've been following this stuff for any period, you get my pain. But really, that's the glass half empty side of the exploration side. The glass half full side is these natural gas companies that have come out, and specifically one that came out on Thursday, Friday morning specifically. Was Cabot Oil and Gas. And full disclosure, they're a client of Entercom's, who's a hardcore sponsor of this show. And it's just so everybody knows, I might have picked another one, but they were a great example of what a good gas company is doing right now. And as everybody knows, we've heard interviews from both Sproul and burning it at Inverness. And what do they say, Stu? Natural gas is going to be what?
Up big.
$4 by summer. I mean, something crazy like that. So gas companies, I think people are looking at and okay, well, what's going to happen? Are we going to see anything good? And when you look at Cabot, they're one of these natural gas companies that have dropped. They're actually, they quarter one, they were able to turn free cash flow, actual free cash flow, GAAP free cash flow. So we can, that's a good number. We can look at that. Their hedges look good. Their hedging forward curve is very nice curve. It's very nice backwardation. Their minimum oil volumes their minimum pricing is like 225, which is really, really good considering the market. I mean, we're only at $1.89 right now. We'll get into sort of the numbers. I have a little hedge placed a little below that myself there. But and so the outlook looks really good. There are very, and analysts are also very bullish. I know you mentioned you have the numbers on them. It's a buy up until what?
Sorry, let me pull it up. Give me a second.
No worry. But I just remember you mentioned at one point that the buy range is much, much higher than all of this stuff. So
yeah,
gas companies are looking very good. What is it?
Cabot, all the signs are in the buy side, strong buy, using almost all the metrics, everything from relative strength down to the exponential moving average, all good.
Yeah. So, and I think you're going to see that on a lot. I think that's what you're going to see a lot of gas companies as they come out and release their earnings. They're going to have the technicals, or specifically, they're going to turn the fundamentals. They're going to turn hard because I think you're going to be seeing free cash flow being started to be generated by a lot of these gas companies. And I think Cabot is a good example of that. So all that being said, there's the data. That's what's happened. There's some examples of companies that sort of fit the categories that I think are most affected by coronavirus. And what are we seeing? Well, I think you're going to see shale oil companies continue to write down assets and do what they continue to do, and they'll be in big trouble. And that's partly why they're begging for Trump to come out in this administration to give them some lending, because they're going to continue to write down billions every quarter. They're going to continue to, unfortunately, have to pump a lot of oil. I mean, it'll be interesting to see what they actually produce in quarter two versus what everyone claims is going to happen, because I'm watching the EIA numbers every week. It's only down 100,000 barrels. Someone's not cutting. Someone's lying here. And I don't know who it is, okay? And I'm about ready to start digging into the numbers here and start scraping oil production. I mean, I have a decent database built up, and I need to go update it through who's cheating, because someone's cheating here. Because everyone says they're cutting, and then week over week, we're only seeing 100,000 taken off the market, and Concho's coming out and saying we delivered high oil production volumes that were on the high end of our guidance range. Yikes. So,
but we covered that in the interview dropping on Tuesday, and that is you can't shut wells off. Oil does not work that way. Coming on and coming off kind of messes with the whole system. So I can understand why people want to keep production on.
No, I understand it too, but then don't come out and say you're going to cut. So that's just what kills me. I'm just looking at, that's what, I mean, you're seeing, that's what you're hearing every single day. Parsley's come out and said they're doing 20% across the board. Concha or ConocoPhillips come out, they're doing like 35, 40% production cuts. I don't know the exact numbers on that, but it's something insane out of the Permian. Well, okay, that's what they're telling me. But then you hear experts like Premier Oilfield saying, well, it's just not that simple. You can't just turn a well off and turn it back on. So I see both sides, but something's got to give here. They both can't, sponsor the show, Tisha Crew. I mean, she has this really great phrase she always talks about, that both things can be true. There's a lot of things in this life that both things can be true. Here, I don't know. I don't know if both of those things can be true.
You're right. So, no.
And so, shale, again, write down assets. They're going to do what they do. Gas, I think, as we mentioned with Cabot's going to be up. I think you're going to see gas companies, are going to come out earnings that are going to be a lot better. They're going to have free cash flow. And that's what I think the expectation is. There's about 75% of these companies left, and a lot of it's on the E&P side. I think the service companies have already come out and sort of, so the data on them is sort of set. And my prediction with them is that quarter two, quarter three is going to be a lot rough than quarter one. But I think anything with an international presence is going to do well, because we've seen that both. We've We heard that weeks ago from them. It's why you got to be a loyal follower of the Energy 360 Network. You start piecing information together. We get 2 weeks ago, we get 10x telling us, wow, it's a lot easier to. We're actually seeing it's easier to sell international, specifically South America, and then we see Schlumberger come out and make 2% year to year international. So I mean, very interesting to see how this stuff all plays out. But I think it's time to dive ahead into the week of oil. And as always, this segment is sponsored by Sandstone Capital Group. These guys do insanely good research. They provide all the levels and all the research via their Energy Glimpse solution. They're going to be writing a couple articles here for Oil and Gas 360 very soon. The newsletter idea, I was told from sources, got axed. Too many good ones out there, but they're going to come and start writing some articles. So it's going to be very fun. You'll be seeing those in Oil and Gas 360 dropping very soon. If you want to get in contact with these guys, go ahead and check them out at sandstonecg.com. It'll tell you all you need to know. You give them a call, 949-561-1818, extension 2. All right. Really, week ahead in oil, I think the things that I'm looking for is May 5th. So this is going to be Tuesday, probation hearing. We know 2 weeks ago was April 21st. They were supposed to come out with a recommendation on, what do we do? Do we cut oil or do we prorate? And they basically pushed. It was like a hung jury, basically. Ryan Sitton came out and said, who's one of the commissioners, as we know, Texas Railroad Commission, who governs all oil and gas production. They have 3 commissioners that sit on the board. They're an independent board, and they each vote. Makes sense, 3 odd number. One of them, Ryan Sitton, he's actually not running for re-election, so this will be very interesting about, not saying I'm watching his vote closely, but I don't know, just very interesting. He comes out, he's close with the Sheffields, and Parsley and Pioneer, you both want to cut production and prorate. Interesting. I'm just pointing facts out, people. So he come out and he's against proration, or he's for proration. He thinks it should be a 20% cut. Commissioner Craddock came out and actually sort of from the legal side said we shouldn't do this because of the mounting legal issues that could and the fallout that could happen with this. We don't know enough information about what's going to happen, and I'm sure if we were to tap our friends over at Haynes and Boone, they would say the same thing, that they're not even like the legal issues are probably so long. And there's actually they actually are having a webinar that's coming up, and they're going to dive into some of these mineral rights very soon, right? Is that something we can announce?
Not yet, but it'll be there.
Cool. It'll be awesome. And so we'll be getting some great information on some of what these mineral rights contracts actually look like. It'll be very interesting. And the third one, Commissioner Wayne Christensen, he basically came out and there's a swing vote, and he was very unsure one way or the other. And what happened was last week, basically the Railroad Commission, they set the agenda for the May 5th meeting, and Appendix A, which starts on page 19, goes to about page 26. I read most of it, but basically what it does is it details how proration will work, and it was seen as, they're going to do it. That was sort of the reaction in the marketplace. It wasn't official, but why would they come out with details on how it would work if they're going to vote it down? Right after that agenda was public, Commissioner Wayne Christensen, as we mentioned, who is the swing boot, wrote an op-ed against proration. And basically what we expect to happen on Tuesday was the same thing that me and Stu predicted weeks ago, 2-1 against. The only thing we got wrong was who was going to be the swing vote. We thought it was going to be Commissioner Craddock. Instead, it becomes Wayne Christensen. We expect no proration. Obviously, things could change. If you want to go read it, I'll include the link that you can go read the agenda for that May 5th meeting. Again, it's Appendix A, starts page 19. It's a decent read, and really, the more you read it, the more you realize why they're voting against it, because some of the legal things behind this are just unbelievable, considering who can opt out, who actually it comes under, and so that really is big. When we look forward at first, let's go to the international news desk. There's some interesting stuff there we need to come up with. Stu, what do you got for us?
Oh, Michael, we got 3 of them that I'd like to go over. And, when you take a look at Australia, you have hit it dead on a lot on our storage. We've been the digital closing bell tanker. I love that one still. We're still working on that, looking for
if you have a cool $17 million that you're looking to invest, go ahead and email us, mtanner@entercominc.com. Hit us up.
Yeah, hit us up for the time. You and I are going to be like pirates running around. And I think we found our first customer.
You want to know what's funny? I watched Captain Phillips last night. I'm the captain now.
Oh, yeah? How fun. Australia actually posted this out on Oil and Gas 360, I think this morning. And it said Australia, 94 million, not big, but they were going to put it in the emergency strategic reserves. But I didn't know that Australia stores in 22 different countries their strategic oil reserves. And Michael, last time I checked, what happens if it's an emergency? Should it be near your refineries or somewhere you can get to it?
It doesn't
And
seem, I mean, not to jump in, but it doesn't seem swift, but I'm sure they have a decent reason, or it's a cost reason. I mean, they could just not have the ability to.
the
Well,
store,
I don't
they,
know, actually. I've never dove into it enough. You're the international guy here.
I was going through the storage numbers and I thought it was interesting, but they've got 4 weeks, 3 weeks to get stuff from the US. What happens, and you and I talked about this, what happens if one of those persons goes out of business? It can't be strategic if you've got a thing on there. So anyway, that was one of them.
Yeah, a two week, just to touch on that, a 2 week gap between when you can actually get your strategic petroleum reserve doesn't seem terribly swift. So
Yeah,
that's about all I'll say about that.
you got it. Absolutely right on. And then had another one with the oil glut to half in May to shrink by 6 million barrels per day in June. This was from Rystad as well. And despite the improvement, the stocks will build, the storage stocks will still overwhelm remaining global storage, which will fill within weeks. You nailed it a little bit earlier on the show, and that is demand is going to be coming out, but it's not going to be enough to burn what's already coming into storage. So that's a worldwide problem. And then
Yes, shut-ins have to happen because even if demand comes back and we do a reverse quarantine, we've still built up stocks to an unbelievable level where because at the end of the day, it's simple math: inflows minus outflows.
Absolutely. And the other one was the Exxon Chevron stuff we've already covered.
Yeah.
But what we're seeing worldwide is there's more activity for investors as well as work opportunities. So there's that combination on that. Anyway, thanks. Back to you.
No, I think those are great stuff, and I always love checking in with the international news desk. When we look at the trading calendar, it's a pretty heavy week, actually. API numbers dropped 2:30 Tuesday. Actually, in the morning, 8 o'clock, if you're just a day trader, I'd be remiss if I didn't mention ISM non-manufacturing PMI index comes out. Supposed to be 37 and a half, according, that's a previous, was 52 and a quarter. So, I mean, to give you an idea of the drop percent, that's a 20% drop right there. Not good to see. Crude oil inventories, 8:30 Wednesday. It'll be interesting. I'm looking for domestic production to finally be below 12 million. It's been about 12.2, 12.1 for the past couple of weeks. We haven't seen really those large numbers of barrels being taken off the market. At least it's being reported. So it'll be very interesting to see what those numbers come out. I'm expecting. My guidance for domestic oil production was down 300,000 to 400,000 per week, and I'm going to revise that down to about 250 to 200. I think we'll see a nice 200 this week. But again, I've been wrong every time, so don't take my word for it. And then really on Friday, unemployment rate's going to come out. It should be about 16%. It's going to be rough. And that's just an overall economy number, and just for everybody, specifically when we mentioned in segment one, talking about the service companies. If you've been laid off, heart goes out to you, man. It's tough, and if there's anything, please, it just stinks. It's about all we can say, Stu.
We're praying for them. It is horrible.
Yeah, and we will hopefully provide some entertainment for you. When we look at really the levels that we have going on, first thing I want to say when we look at levels for the week, my levels have been spot on. I haven't really said this because I've just been trying to stay humble, but non-humble brag. My levels have been money for 3 weeks, and really, if you looked at my oil charts, I've been setting those levels. This is a daily routine I've been doing for like years, and this is the best month stretch I've gone through with just setting levels. So I don't know if that's just because the game face. I've been on the podcast. Now people are watching my picks a little bit, but it's been good. And when we look at the levels, we look at price action. If you're a TomCat, you're bullish for oil. And when you look at volume, pivot points, volume points continue to increase, which is always great to see. levels, when you look on a bull side, 1793 is a really good level. I think that's really the pivot point. Crude oil for the June contract stopped trading at 1978. Why I'm hesitant to go complete bull on oil, because June contract 1978, I think negative pricing is going to happen. And at what point is the curve going to rotate itself back down because of the storage issue? Like right now, I think this is, I don't know. This just freaks me out a little bit. And, consider, you know what I mean? I mean,
oh, Mighty Kreskin, what price do you think negative will go?
oh, yikes. I mean, the stuff I've been seeing, the scary stuff, they're saying negative 100. But I mean, that's just more. I mean, I don't want to say it's just a number for the sake of numbers. It's just a mechanic, as we chatted about, and shout out another previous episode. Go back and listen to our old episodes. It was like episode 7 or 8. We talked about negative pricing and actually what that means. It's more of a mechanical issue with the way the markets work than necessarily what operators are actually getting for their oil. But nonetheless, scary as well. So before I go complete bull on this week and say we're going to see $25, it's going to, at some point, we're going to have to rotate here. And especially when the USO does its roll, which is coming up this week, which is another thing to worry about. The USO, the United States Oil Fund, their roll is this week. So a lot of volume is going to be switching over from the June to the July contract. So watch that. If you're a bear, we know the levels on the way down: 1703, 15. 23, 1408, 12, 14, or 41. Those have not changed for a while. I love those levels. And it'll be very interesting to see again when that curve happens, or when oil flips from this June to the July contract in terms of rolling over, to be very, very interesting. When we look at the commitment of traders, I mean, really the hedge funds don't care. They're long oil, and now they're long options that are far out in the future. So they're taking into account purely trading oil fundamentals. They're not necessarily buying oil contracts in June 2020. So that's what you're seeing when a lot of you talk about hedge funds and managed money getting long. Swaps come back in, drop on the long side, which was good to see. And shorts on your producer merchants and on your hedges for producers, which is up. So they're taking out a lot more insurance. They're not, it was really actually a normal commitment to traders report. You can go check that out at cotreport.com. Anything else that happened last week, Stu, that we need to bring up and we need to chat about? I think I've hit everything on my list. Did we miss anything? I know you've got, how much research you've got down there? You got like 60 pages. I'm sure we missed something. Oh my, yeah, that's a lot. What we missed? There's got to be something we missed.
I'm afraid this is this week's.
Woo! So I'm sure we missed something. And if there's anything that you guys wanted to hear, please, again, reach out to us, mtanner@intercominc.com. Link with us on LinkedIn. But I think we should go ahead and move into our picks for the week. And obviously, our lawyers make us say this so we don't get sued. This segment is for entertainment purposes only. Everyone on the show, i.e. me, Michael Tanner, and Stuart Turley, we invest our own money for our own account, and we do not manage any outside money. We do not give investment advice. We do not offer securities or have any involvement in the regulative side of the industry. Remember, investing is risky, and you can and will lose your entire principal at some point. That being said, our 360 non-official, official fund picks are going very well. Stu, I want you to give an overview both of how your portfolio is doing, and then TomCat, he's back into it, and then I'll jump in and talk about how my side of the portfolio is going.
Well, I did some moving around on mine. I got LNG still, and Enphase I'm still hanging on to, but I added, when you take a look at Noble, the charts are really looking up on Noble right now. The stats are looking really good for a buy. And the exponential moving averages really kind of jumped right on in on that one. So I got Noble, and then I've got Pioneer. Pioneer also hit that mark for me. Mm-hmm. Now, Fang and Rattler. Fang is
Diamondback. We've overviewed their hedge position,
and they are looking pretty good for me right now. Now,
okay.
Diamondback is also got Rattler, which is Rattler Midstream, and
I see what you're doing there.
Go ahead. I mean,
well, you're just tagging up their upstream and a midstream as a little in portfolio hedge. I love it.
And they've got another company that I'm still researching on that Fang just came out with. So I'll come up with that one here in a little bit. But I'm doing some more homework on Fang and Rattler.
I love it. What TomCat do? He's back in because if I remember on Friday he was sitting out. He was still there, or
TomCat
when we
got
chatted
out.
with him.
Yes, TomCat got out, but he gave me
I
his news list this week. So he got his money out of Apache, but he's looking at the jump back in. On Cross America Partners, oh, by the way, Michael, your picks, my picks, and TomCat's will be in widgets on your landing page for your show.
Yes, I
So
am excited about that. So
I
will make sure whenever that's live, we will make sure just to direct people. You can see all of our picks in real time, the percentages. We're not trying to hide anything here.
Oh no, and so I'll have that up on your site tonight. Okay.
Oh, even better. So
So
when you watch this Monday morning, you're going to be
yep.
listening to this Monday morning. This is dropped before the market opens. You can see my picks, www.oilandgas360.com. Just go to my landing page for the 360 digital closing bell. You'll be able to see all of the picks. I am excited about that.
You bet. It keeps me honest, and I think your predictions are going so much better than you have in the past because of accountability.
Oh,
So, okay,
100%.
moving right along. Got to go. Cabot, he is rolling in on that one.
Oh, he's in Cabot. So good. We're seeing the same thing because, as we know in segment one, that was our ideal
Now
gas
Cabot's
company.
buy-in is at 21, so we'll watch that one. B&O, which is the United States Brent Oil Fund, the buy-in on B&O is $7.15. Right now, it's at $7.
He's getting in on the Brent USO.
Yeah.
Oh, so, I don't know if that might be the first thing he's done that I disagree with.
Well,
Interesting.
We're taking note. Okay, Michael's got a no on this one. Okay.
Well, he must not be on Twitter because if you're on Twitter, you're never allowed to do you can't trade the USO. It's a no. But that's interesting. He's a smart cat. You can make money. You can make money trading any asset if you don't know it. So if anyone I trust, it's TomCat. I'm not sure if that's a little above my risk tolerance. Trading is just managing risk. So
anyway, Range popped up on his radar. And
they're a gas company. I love it. So the technicals are turning, I assume.
Absolutely. And so when you take a look at Range has been a long-term, full disclosure, intercom. You and I have always had the same theory, and that is good management, good numbers. And I really like the management over at Range. Good people. And
cool.
Their technicals are really looking good. So Range he's going to buy in at 650. Currently, it's at 606. So Range ones to watch.
I love it.
Good feedback.
Good feed. And we'll be watching this USO Brent. I'm going to be watching that closely because maybe he's seen something I'm not. I'm always open to being wrong. I enjoy being wrong because it usually means I learn something. If I'm right, I don't learn anything. I just confirm. You know what I mean? I like being wrong because it means I get to learn something.
Well, I got nothing.
And so, all right, my picks, and this is where I'm going to be lame and say I'm not doing anything. I'm in a Bonanza Creek at 14.89. Currently, stocks trading at 16.89. I'm just going to stick with it. I think, even though it was down, 50 cents in that last, I'm going to stay in, and I'm already up huge, as our famous president would like to say. Natty Gas, again, I'm in long term. I'm holding that at $1.826. I'm going to have that till the summer. I just think that's, and really what I kind of want to just bring up to you is what I'm doing with this is I'm building a portfolio here. And part of what I hope you take notice is how we go about doing this. And a portfolio needs to have every type of asset to every type and be exposed to every type of market that you think is going to do well. Like you need to have long-term stocks. You need to have long-term holds, You need to have short-term holds. You need to understand that there are multiple ways you can build a portfolio and everything. You should have a pure hedge in there. Right now, I don't. I'm just bullish on natural gas. I bought it. I bought a futures contract and we're holding it. So right now we're, even both of our, and I would say Stuart's portfolio is a little more hedged than mine because he's in a little different asset classes. I'm not. I'm in hardcore shale and natural gas, which is basically the same thing. So right now I'm on the lookout for a long-term hold and a hedge position. I don't know what quite that is yet, and I'm looking at a couple different things. I think the easy answer for a hedge is just to start shorting some of these shale oil companies. And I might do that. I might take out some put options, a lot of put options on some of these. Like Denbury looks very, very spicy to just buy a bunch of 3-week put options and just hope it, or not 3-week, 3-month put options and just hope it bankrupts by then. Because that could, so I mean, that's where my mind's at for my hedge position. In terms of a long-term hold that really I want to keep in specifically with Bonanza Creek, I don't know. It'll be interesting. I'm still scanning. I think everybody knows what I look for. Free cash flow that's gap approved, as we call it. We're going to start doing that on our podcast. Can we do generally accounted podcast principles? Gap approved. Just
Rock
pop it
on,
in
man.
there.
I like that one.
Yeah, a big old stamp of approval, then it'll be fine. So that's how I'm looking at my portfolio. Right now I'm hanging tough, but look for me to add a hedge position probably on the short shale side when we look at some options plays. And then I will look to picking something up to continue to hold that along. But I think we have a surprise call-in guest right now. Nick Barry's on the line. We're going to go ahead and jump over to him. But we've got some. We can hold him for a little bit. What do you got?
No, I'm good. I'll finish up at the closing.
All right. Well, let's tap him in then. As always, high-level stuff from our boy Nick Barry. You can check him out at Nick J. Barry on LinkedIn, Nick J. Barry 24 at gmail.com. I'll make sure to put his email in the show notes so I don't forget about that. But I think we're pushing a large show here. I'm not sure the total time on this, but it's been a while. And, but before we let you guys get out of here, we got some really cool news we want to mention on something we're going to be dropping this week. Stu, what is it?
That Michael Moore film we talked about on Friday, we've got several clips on it, and you and I are going to do a special. We will come out with a Michael Moore special because it's a total energy.
Well, first you can find it. It's called Planet of Humans. You can find it at Michael Moore's YouTube. It's already up to like 5.4 million views. And just before, because I'm excited, I want Stu to give an overview of what we're going to chat about. But if you don't watch the video, really, it's not pro-fossil fuels. It's not a pro-fossil fuels movie, but it is anti-renewables. And their overall thesis is the reason why, partly why renewables stink is because they require more coal, natural gas, and crude oil to produce than if we had just produced natural gas and crude oil electricity for this time. Adding on renewables only increases our use for that. And that was sort of the angle they took.
And we're going to go into greater detail, but it's also the financials. You are such a financial analyst on all this kind of stuff. You and I are going to be paired for the big financial stuff that was in there.
I mean, I've got 4. I know you have 6 screens you look at, 25 pages. I've got 4 screens here that are, so we'll get the power stations riled up for this one. But I'm excited to have this one. It'll kind of be our first special that will be dropped on the 360 digital closing bell. So look out for that. We'll hopefully many more to come. But with that, I'm going to go ahead and let you guys get back to work. Thank you for checking out the 360 digital closing bell. You will see us tomorrow for the 360 digital ticker. See you guys next time.